Welcome to Be Rich Podcast, the show where we unravel the complexities of the stock market and equip you with the knowledge to become a savvy investor. I'm your host, Vinod, and today we're going to dive into a crucial topic for everyone to step into the world of investing. In this episode, we'll be exploring 25 essential stock market terms that every investor should know. So, whether you're a seasoned investor or starting out, stay tuned. We will demystify these terms and help you build a solid foundation for your investment journey. Let's kick things off by understanding some fundamental terms that form the backbone of stock market knowledge. Annual report. Annual report is like a company's report card providing a wealth of information from cash flow management strategy. It's essential for shareholders to gauge a company's financial health and direction. As Warren Buffett has always said, annual report is critical and everyone must read it and from cover to cover and read everything, including what the owners of the company are saying and the board of directors are saying. It gives you a vision of where the company is going. It kind of gives you an idea where the company has been. And it's a great method of knowing if the company is a right fit for you or not. Arbitrage. Arbitrage might sound complex, but it's about exploiting the price differences between markets to turn a profit. For example, buying a stock at a lower price in one market and selling it at a higher price in another market. This is an arbitrage. Or for the famous Tata DVR arbitrage, which is happening right now, where you buy the Tata DVR shares, and for every 10 shares of Tata DVR, you're going to get a Tata Motors. So this is an arbitrage. Averaging down. Averaging down involves in buying shares at one price, and as the price drops, keep accumulating more shares. So your average buying price of the share becomes lower. This strategy can be used when you believe the market's perception of a company is inaccurate. For example, Tata Motors DVR again. You might have bought the share for 400 rupees, and today the share's price has dropped down to 385 rupees. What does that mean? You accumulate more of Tata Motors DVR shares. The market may be having a perception that Tata DVR's price needs to be lower, but you being more knowledgeable in the information about Tata Motors and Tata Motors DVR can pick up the Tata Motors DVR shares at a lower price, averaging your total price for the DVR. Bear market. A bear market refers to a prolonged period of falling stock prices, often accompanied by an investor's pessimism. It's a term that signifies a market downturn. Prolonged period is a vague term and can depend from person to person, investor to investor, analyzer to analyzer, stock analyzer. It also, some people go by percentage. With bear, the market must be correcting at a certain amount of percentage for it to be classified as bear market. So keep that in mind. Broker. Broker is a middleman who executes trades on your behalf, earning a commission or a fee in return. They play a vital role in connecting investors to the stock market. But these days, in the age of digital apps, buying shares online by yourself, the role of a broker is diminishing rapidly. And one of these days, we might not have a broker at all. Moving on. Let's explore more terms that shed light on market dynamics and trading strategy. Dividend. Dividend are a portion of a company's earning distributed to shareholders. From the profit, it could be. Not all companies offer dividend, especially those in growth phases. A famous example is, of course, Berkshire Hathaway. Warren Buffett is sitting on a lot of cash and he's not paying out any dividend. And he doesn't plan to pay out dividend in the near foreseeable future either. Sensex and Nifty. Sensex and Nifty are stock market indices in India representing share prices of selected companies. They provide insight into market trends and overall health of the economy. Bid and ask price. The bid price is what a buyer is willing to pay for a share, while the ask price is what a seller wants to receive. So when you open your app, the price which you bid for is the price you're willing to pay to buy the share. While the ask price, if you see, is the price which people are willing to sell the share to you. The difference between these prices is known as the spread. So what is the spread? The difference between the bid and ask price is called the spread. Trading volume. Trading volume indicates the number of shares the exchanges on a given day. A higher volume signifies increased market activity. So usually large cap companies will show higher trading volume, and small companies will show a smaller trading volume. So the trading volume gives you an idea on if you can easily sell the share or is it harder to sell the share if you're holding on to it. This is something to keep in mind, especially when you're buying small cap companies. Market capitalization. Market cap is the total value of a company's outstanding shares. It's a quick way to assess a company's total size and market value. Now let's delve into the different trade orders and strategies that investors use to navigate the market. Intraday trading. Intraday trading involves buying and selling stocks in the same trading day. It requires a quick decision making and market analysis. It's something which we don't recommend, but now you know what it is. Market order. A market order is a request to buy and sell at a current market price. It's quick, but execution price may differ from the expected price due to the market volatility. That means you say buy it at price. Whatever price which is available at that point in time, the order is executed and you get that price. So during the trading day, the price might fluctuate going up and down by a few percentage point, or even large swings might happen. But you'll get it at the point whenever you place the order, that's the price you'll get it at. Limit order. A limit order specifies a buying price or a selling price to ensure the trade is executed at a specific price or a better than price. It offers more control over the trade execution, but may not always be fulfilled. So let's say you want to buy a share at a certain price, you can tell the order saying, I only want to buy it at this price. If the market comes to that level of pricing, you'll execute your trade. Otherwise, you'll end up going through the day and not buying it at all. Day order. A day order remains active until the end of trading day. If not executed, it's automatically considered cancelled. As we wrap up, let's explore some investing strategies and additional stock market concepts. Portfolio. Your portfolio is a collection of investments representing your holdings across various stocks. Liquidity. Liquidity reflects how easily an asset can be converted into cash without affecting its price significantly. High liquid assets are easy to sell quickly. IPO and secondary offering. An IPO is when a private company becomes public by issuing shares to the public for the first time. Secondary offering involves selling more shares after the IPO to raise additional funds. Going long. Going long means betting on a stock price to rise over a period of time. Investor aims to buy it low and sell it high to capitalize on price increases. And there you have it, 25 essential stock market terms that are integral to your journey as an investor. Understanding these terms empower you to navigate the stock market with confidence and make informed decisions. Remember, the stock market might seem overwhelming at first, but to grasp these key concepts, you're setting yourself up for success. Thank you for tuning in to Be Rich today. I'm Vinod again. Until I see you next time, happy investing. Bye.